Hi everyone, this is Brad Wolff, and this is the end of day Emini review. Today formed a bull trap as well as a bear trap that led to a triangle, which is a trading range day. Whenever you have large breakout bars on the open, traders should assume that the market is forming a trap and likely forming a trading range. Big bull bar, weak follow through. Bulls are quickly to exit and bears will short. The problem with the bears shorting here or here is at this point there's been a lot of buying pressure on the open, and most days that are strong do not have strong bull days. In other words, most strong bear trends do not have strong bull bars on the open, and most strong bull trend days do not have strong bear trend bars on the open. Any bear that sold here or here would be quick to exit on these doji bars. Any bull that bought here would likely be quick to exit after this disappointment bar. Low probability, bar 1 is the low of the day. That is a reason alone for traders to look to be quick to exit. Most bears that sold here would not wait until here to get out. They would get out either on these doji bars as the low one failed and started to turn up. Bulls that bought here, most would be quick to exit because this bar is testing the close of bar 1 and the breakout points of this bear bar here. So when this bar formed a doji, a lot of those traders would exit. If you're buying a big bar, your risk is big. Therefore, you're buying on the hope of momentum. And if the momentum is not there, that trader's premise is gone. Would a bull buy this outside bar? Some might. Some might even buy this doji, but it's not ideal. A bull that buys this outside bar is buying a potential wedge, 1, 2, 3. If they did buy, it's reasonable to get out below this bar. Most traders should not buy here because it's the third push in a likely trading range day. Overall, lots of trading range price action. Bear that sold below here, good follow through. However, again, lots of bull bars. Most bears would exit above this bull close here. Too much risk of some kind of double bottom here or here, or a higher low after this rally and the market forming a complex rally. So leg 1, pull back, leg 2. Some bulls would buy here, other bulls would buy here. What about buying this high 1? Most would not. It's the third leg up in a complex top, 1, 2, 3, or 1, 2, 3, and a potential failed breakout of these highs over here. There was a bull that bought the high close of this bar. On some time frame, this bar closed on its high and traders bought. Those bulls are going to be significantly disappointed by this sell-off, and they're going to use this rally to exit break even. Bears will sell below this bar. Bulls would exit. What about bulls buying and scaling in lower? Some might. However, with this being the possible third leg up, it's a bad idea to scale in on a trading range day, especially after the second or third leg. Therefore, most traders are selling here. 3 consecutive bear bars, sell to close, sell below this bar, below this bar. What about selling below this bar? You can, however, it's a dangerous bar to sell. It's a sell climax bar, and most sell climaxes or buy climaxes lead to sideways. Buy climax, sideways. Buy climax bar, sideways. Sell climax, sideways. Big sell climax, sideways. Sell climax bar, sideways. Buy climax, sideways. Big bear bar, sideways. Most traders, if they did sell here, would be quick to exit when this bar or this bar failed to form another strong bear bar. Too much risk at the low of the day. At this point, it's a parabolic wedge, reasonable for bulls to start buying if they're aggressive. Bears, it's reasonable to exit above a bar. Most bulls should wait until the market's had at least a few attempts to form a second leg. Trading range, low in the range, the market broke out above a bear flag. Here's the bear flag, here's the bull breakout. It's reasonable to bet on a second leg up. At this point, it's a third push up, 1, 2, 3, at resistance. The low of this bar, which was the start of the bear sell-off. Reasonable for bulls to exit below one of these bars. Once you get a 3 or 4 bar micro channel, bulls will start exiting and bears will start selling. Sell the close here, sell the close here, sell the close here. If you are selling down here, it's dangerous because it's an extended micro channel. This is possibly leg 1, pull back, even though it's inside bars, and leg 2. Bears exit above this bar, aggressive bulls buy, or they buy here. Some bears will sell below here or here, betting on a second leg down. The bears ended up getting a few legs down here. However, at this point, lots of trading range price action, failed breakout below the lows here, it failed to break out below the lows here, and all through here. Bears would exit above this bar and aggressive bulls would buy. Most important thing on a day like today is to recognize the market's in a trading range. Whenever you get 2 or 3 legs up, here, here, or here, it's better to look to sell. Whenever you get 2 or 3 legs down, such as here, here, and here, it's better to look to buy. Or at this point, 2 legs down, look to buy, don't look to sell. Here, 2 or 3 legs down, look to buy, don't look to sell. If you enjoyed this video, please go to the brookstradingcourse.com website where you can find more information on blog posts as well as learn more about the trading course. If you would like to see live price action commentary, please go to the brookspriceaction.com website where you can learn more information about the trading room as well as access a free trial. Thank you for watching this video.